Melbourne's property market has already hit rock bottom. The government has no money, keeps raising taxes every day, and the economy is failing to improve, causing property investors to withdraw from the Melbourne market. However, many people haven't yet noticed that Sydney's situation is even worse than Melbourne's. This year, 3 major policies have been introduced to target property investors. In the latest ranking of the economic strength of Australia's 8 cities, Sydney shockingly ranked second to last, even worse than Melbourne, only slightly better than Darwin. Sydney property prices have recorded an increase over the past 17 months and have now reached historical highs. However, the rate of increase has slowed significantly over the past 7 months, with monthly growth being almost negligible. Will these factors lead to a downturn in Sydney's property market? Hi, I'm Alex. Welcome to AusPropertyStrategy, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. Many people might not believe that Sydney's economy is worse than Melbourne's, but after reading this report, I'm convinced. The vitality and health of Sydney's economy are already at the bottom in Australia. In the latest report on the economic performance of states and territories released by the Commonwealth Bank, 8 key economic indicators were assessed, including economic growth, retail consumption, fixed asset investment, unemployment rate, construction completion value, population growth, housing loan increments, and construction starts. New South Wales' overall performance ranked second to last in Australia, just slightly better than the Northern Territory, while Melbourne ranked third from the top. For the year ending in March 2024, New South Wales' real economic growth was 5.1% compared to Victoria's 6%. Compared to a year ago, New South Wales' unemployment rate dropped by 18.7%, while Victoria's dropped by 13.8%. The tightest job market, where almost everyone has a job, is South Australia, leading the nation in unemployment reduction. According to the Commonwealth Bank's analysis, proportionately rather than by volume, South Australia has the best economic performance in Australia, ranking first in 3 indicators: unemployment reduction, increased construction completion value, and the lowest decrease in construction starts. In overall economic performance, Western Australia ranks second and Queensland ranks fifth. For the indicator most concerning to our channel's audience, the proportion of new housing loans, Western Australia ranks first, Queensland second, and South Australia third. The ranking is consistent with the increase in house prices. New South Wales, with its large scale, has fallen to 5th place in the new housing loan ranking. This directly reflects that the vitality of New South Wales' property market is not very high. Throughout almost the entire interest rate hike cycle in Australia, Sydney's property market has been on the rise. The current average price of a house in Sydney has reached $1.66 million, with a 1.9% increase in the second quarter. However, signs of decline have appeared in Sydney's property market, with the rate of price increases halving in the second quarter and some high-end suburbs even seeing price drops. The worst performing suburbs are in Sydney's inner south, where house prices fell by 4.4% over 3 months, with a median price of $1.97 million. Next is the northern beaches, where prices dropped by 3% to an average of $2.57 million, followed by North Sydney and Hornsby, with a 2.7% drop and a median price of $2.92 million. Sydney's apartment market is performing even worse. The median price for apartments across Sydney fell by 0.6% in the second quarter, now standing at $797,000. The buying power in the Sydney market is with those who already own homes and have borrowing capacity, or those who can get help from mom and dad. For young people, buying their first home in Sydney on their own has become a dream. Although the average price in Sydney saw a slight increase in the second quarter, the market has significantly slowed compared to last year. While house prices have remained relatively unchanged, people have less money and borrowing capacity, making home unaffordable for many. As long as interest rates do not fall, the longer this drags on, the weaker the upward momentum in Sydney's property market will be, potentially leading to stagnation or even slight declines. Rising interest rates have increased the cost of buying homes for investors, restricted the budget for first-time home buyers, and prompted property investors to sell investment properties to maintain their own homes, reduce leverage, and save costs. This has led to a decline in Sydney's apartment market. Meanwhile, more new apartments are being built, changing the supply-demand dynamics. The gap between house prices and apartment prices continues to widen, and this trend is expected to persist for the next 5 to 10 years. Sydney is no longer expanding outward, but upward. Each new apartment building adds to the number of apartments on the market, while the number of standalone houses decreases. Developers need to acquire houses and combine lots to build high rises. Additionally, almost all standalone houses in New South Wales can now be subdivided into duplexes, further enhancing the scarcity and market value of standalone houses, with their growth rate outpacing that of apartments. These market price trends are the result of a complex interplay of supply and demand factors. The three policies introduced by the New South Wales government this year to curb the property market will gradually take effect in the coming months, continuing to cool the market. Last Sunday, the New South Wales government proposed a bill to ban the no-ground termination of leases, significantly increasing the notice period, giving more rights to the tenants and reducing the rights of the landlords. This bill will be reviewed by the New South Wales Parliament in August. If passed, the bill will become law on the 1st of January 2025. Let's take a closer look at what this means. In New South Wales, landlords can initiate terminations, and tenants can also choose to terminate their leases. There are two types of long-term leases: fixed-term leases, such as a one-year lease, and periodic leases, where the fixed-term lease has ended, no new lease has been signed, and the tenant continues to live in the property, paying rent every 2 weeks. Under these different lease frameworks, the New South Wales Residential Tenancies Act 2010, number 42, stipulates specific notice periods for both landlords and tenants in various situations. For example, at the end of a fixed-term lease, if the landlord decides not to renew, they must give the tenant 30 days notice, while the tenant only needs to give 14 days notice. In a periodic lease, if the landlord wants to evict the tenant without providing a reason, they must give 90 days notice, while the tenant only needs to give 21 days notice. If the landlord has signed a contract to sell the property, they must give 30 days notice to evict the tenant if they are still within the fixed-term lease, and the notice must end after the fixed-term lease. The tenant only needs to give 14 days notice and does not have to pay a brick lease fee. For periodic leases, a 30 days notice is sufficient for the landlord to evict the tenant, while the tenant can leave at any time without giving a notice. Of course, there are many other provisions, and for those who like to delve into details, reading the actual legislation is a good idea. You might notice that under the current legal framework, landlords are already at a disadvantage, and this disadvantage will increase once the New South Wales government changes the law. Under the new law, New South Wales landlords will no longer be able to evict tenants without providing a reason, whether under fixed-term or periodic leases. Landlords must give a reason from a specified list provided by the New South Wales government, and reasons not on this list are not reasons. Reasons include tenants breaching the tenancy agreement, property sales, major repairs, converting the property to a primary residence, and more. Not only must reasons be provided, but landlords must also present evidence supporting the reasons when issuing the notice. Failure to provide sufficient evidence will result in fines. As a result, under the fixed-term lease, landlords wanting to evict the tenant must 1. Provide a reason, 2. Provide evidence, and 3. Give 90 days notice. For periodic leases, they must 1. Provide a reason, 2. Provide evidence, and 3. Give 30 days notice. I don't know how you feel after hearing this, but my feeling is that buying a property in New South Wales for long-term rental seems quite unappealing. With low rental yields and having to accommodate tenants extensively, it's not worth it. Many property investors will likely choose to sell their investment properties due to this new law. If the new law is passed, it will be added to the Residential Tenancies Act 2010, applying throughout New South Wales. However, there is an issue. This law can govern New South Wales tenants but cannot govern landlords living in other states, as it is a state law. I look forward to seeing cases of New South Wales tenants and landlords from other states going through a tribunal or a court. It'll be chaotic. In the latest budget, the New South Wales government introduced a hidden bill to freeze the land tax threshold. Why is it hidden? At first glance, it seems insignificant, but a close analysis reveals something huge. The land tax threshold for 2024 is set at $1,075,000, which will remain unchanged next year and won't be adjusted for inflation in the future. This measure is expected to bring in $1.5 billion in revenue for the New South Wales government over the next 4 years. In New South Wales, owner-occupied homes are exempt from land tax. Only investment properties with land value exceeding the land tax threshold are subject to land tax, which is paid annually. The amount is calculated as the portion exceeding the threshold multiplied by 1.6% plus $100. For example, if your investment property's land value totals $1.2 million, you subtract $1,075,000 and multiply the difference by 1.6% plus $100, resulting in an annual tax of $2,100. Assuming the 1.6% tax rate and threshold remain unchanged, you will pay more tax over time, as land values increase. Those who previously paid little in land tax will now pay more, and those who didn't pay any land tax will now have to. The government is slowly taking money out of investors' pockets in New South Wales without their notice. This tactic is similar to Victoria's open approach of taxing property investors heavily. However, New South Wales is more subtle about it. Overseas buyers of property in Sydney, New South Wales must pay an 8% stamp duty surcharge. Local buyers pay 4%, while overseas buyers pay a total of 12% stamp duty, which is 4% plus 8%. Starting in July this year, the stamp duty surcharge increased from 8% to 9%. Furthermore, overseas property owners must pay a 4% land tax surcharge annually on top of paying regular land taxes. This extra cost has deterred many overseas investors. The land tax surcharge has now increased to 5%. It seems that targeting overseas investors is a permanent strategy with no signs of easing. New South Wales has become the strictest in Australia in penalising overseas investors, surpassing even Victoria. I see a trend where Sydney is becoming more like Melbourne, with property investor crackdowns likely becoming a primary strategy. Their logic is that property investors are to blame for rising house prices, and by targeting them, housing will become more affordable for the middle and lower classes. The Australian Bureau of Statistics has just released the inflation report for the second quarter of 2024. The trimmed mean CPI is slightly down, but there are still talks about a rate rise. We don't know what the result will be in the coming RBA meeting, but an interest rate hike in Australia seems logical. Raising rates could push the economy into recession, while not raising them could fail to curb inflation. This is unlike the US, where they aggressively raise rates to suppress inflation and have now secured a soft landing. They will enter a rate cut cycle soon. If you made it this far, please give me a thumbs up, subscribe, and share this with your friends. Turn on the notification bell to watch new weekly videos, and have a good one. Bye.